Well, this week we saw a little bit of a explosion in yields again. So we're seeing that deficit issue still weighing on yields, but actually turned around today. So I wonder if that's the end of it or if we're going to see this progress from here on. Really, nothing has changed though. Like deficit issue still untouched, tariffs are still unchanged. We had the 90-day pause on China. That's slowly wrapping up, and really no progress on China yet. So I think bonds are really starting to feel like the deficit issue is just not going to get tackled.
No, I mean, look, like I've been saying this for some time, at least a couple weeks now. It feels like the deficit is like drifting away, slow and steady, just out of reach and going out, across the horizon. Where the solution now is very clear that what they're doing. No one's talking about yields anymore, right? That no one cares about the bonds right now. I think what's going on is very simple. The government is basically leveraging their plan to lean on the fact that they can try and free up some GDP growth and grow their way out of the deficit issue while trying to somewhat cap spending in the process. And the bond market doesn't like that because essentially what you're providing a two-sided a two table scenario, right? Increase spending to or excuse me, increase the deficit or risk deficit increases by tax cuts, which will for sure reduce revenues, in turn of hoping that growth will down the line offset that by going up, therefore negating that the percentage of spending against gross domestic products, which is what we typically measure as the deficit. Now, the reason that this is problematic, and it sounds a bit jumbled altogether, but only one of those things is actually guaranteed, and that's to cut revenues and put upwards pressure on the deficit, right? The growth aspect is not necessarily guaranteed.
Yeah.
So
Well, especially
the
with where rates are right now, like the Fed is trying to dampen growth and dampen inflation. And so it's really like we're driving with one foot on the gas and one foot on the brake.
That's a good point. Yeah, yeah. And then on top of that, you're going to have the deficit free up, right? So you're essentially going to add more to that, add more to the national debt, which isn't that the debt level is not really an issue, but it's just the pace at which we're adding debt. And your idea is that you're going to be able to outgrow the percentage of GDP by just growing GDP and slowing the rate of debt growth. But you increase debt, interest rates are still high. That compounding effect of interest expenses, where like the amount that you're paying on debt will just rise, right? So a good way to think of it is if you got $100 outstanding, you're paying X percentage on it, and your bet to get out of debt is to borrow more money. Well, you're going to have a greater sum of money being under that interest expense. So you're going to have to really be able to grow. And I think the bond market at least, is a little concerned on the viability of that plan. And quite honestly, I see this a lot now. Everyone's saying, "Oh, bonds are dead. Bonds are dead." And some would say this is a great place to actually get long bonds because sentiment is beyond the shitter. Literally, it's cooked. But I don't think it's a good idea just yet. However, I will say in the long run, I don't think bonds are cooked long in a long enough horizon. They won't be. It's just we have to get through this little hiccup. And I
Yeah,
think what
I think once a recession hits, bonds are going to come out of the woodwork because America's going to take every other country down with it, and bonds are going
oh,
to be the only place you can hide.
and I think the biggest debate, right? And this is I think we've spoken about this privately, but the biggest debate is you got a deficit 6-7%. You got the Fed at 4. Can we run a recession? Is it possible to run a recession, or is it really just a game of inflation, where inflation will just will stay? Like if we look at inflation on a progress chart, like we're getting down to 2%, right? Inflation's back to where we were in 2020, theoretically, right? Like if you look at it, 2019, 2020, 2018, we're in that range, that corridor. Yet, you look at the 2 year, right? So we look at the 2 year interest rate, and we are just so far from that level. And the argument here is very simple. Why are rates so much higher? Like Trump will just say the Fed's late, the Fed's late, the Fed's late, and he'll just try and, throw Powell under the bus. But, think if you look at it more objectively, rates are at 4%, right, on the 2-year. Inflation is at 2.3%, and we're not actually like below, like rates are significantly higher than where they were in 2018, yet inflation is not significantly lower, which is telling you that the neutral rate of interest has shifted up. And that's the base rate at which rates must be without them being restrictive or accommodative. Think of that as the baseline rate where nothing really breaking, not really overheating the economy, but you're not really breaking anything either, just stagnant. And that rate it moves up and down over time. It's impossible to measure. It's just a rough estimate. Everyone has their own estimate, but it's just clear from the term of the economic data that the baseline of interest has lifted post COVID. And I think that this is the actual problem that on the table in terms of like deficit and whatnot. Yeah, these large deficits in positive in overproducing economies with a positive output gap are going to lift that neutral rate. And the argument here is like, look, if you're not getting a recession, or how can you get a recession when you're running over capacity? And the answer is you really can't. And the question comes down to, um, do you run into the stagflationary risk where you have growth kind of gets eaten up by inflation? Inflation is just really high due to high government spending, and you get the stagflationary economy. I think that's really the risk here. That deflation spiral, right? That everyone's like so worried about. That's like crisis related. I don't know if that's the type of thing we have to be worried about long term in this setup, because at the end of the day, like, okay, I'll flip the cards. If Trump came out next week and said, you know what, screw my tax tax cuts, let them expire, we'll hike taxes, let's balance his budget. I think that what I just said, everything I just said in the last like couple of minutes in terms of inflationary pressures, higher output gap, that gets completely inverse. So now you're gonna be looking at a deflation issue where output gap collapses to zero. You go into a negative output economy, essentially running below capacity. Inflation falls like a rock, and the Fed is just cutting frantically because they're just trying to stimulate anything at all costs.
Which
So like
that would be the normal game plan with a normal
that would be the
president.
normal,
That's what they would do.
right? That would be the normal thing. But what Trump's doing is like, and you can't really blame him. Look, every president's going to have their own fiscal plan, their own plan, their own agenda, and at the end of the day, look, it might work. We got to just see what happens. But his plan is to. It was at first to address the spending issue, but they couldn't. The spending is what it is. They couldn't really push anything substantive through, so it just got pushed aside. And the next focus is going to be to try and outrun the issue, just grow out of it, and try and control one side and let the other side loose and balance the seesaw type of thing. Which, look, it could work, but the avenue of of highest responsibility would be to say, look, um, deficits widening, tax cuts should expire. We should focus on controlling spending and let growth do its thing. If we go into a recession, we'll stimulate out of it. But given the deficit is where it is, again, goes back to my first question: is it really possible to get a recession with a 6-7% deficit?
Yeah. It really seems like, if we go back to bonds, it really seems like bond volatility affects stocks more than the actual yield. Like, yeah, the yield can keep rising, but as we saw yesterday when the 30-year just collapsed, that's what really started crashing stocks on Wednesday.
Yeah.
So I think
Look,
it's really about the rate at which the yields are rising that matters more for stocks than the yield itself, at least in the short term.
this is true. I think like, let's look at term premium again, because this is just something that I think we haven't got the update for this week. I mean, I think tomorrow or whatnot we'll get the update, but nonetheless, term premium is extremely elevated here. And I think that when you look at bonds and um, utilities and other alternatives, right, you see like the 30-year running, but we have to basically back out the risk-free rate, right? Because if you look at it, let's look at the 10-year, it's a little cleaner. The 10 years at 4.5, right? You know, you look at inflation adjusted, so real yields, right? So let's look at the real yield rate, and we're at 2.23 on reals. So 2.23. This is more competitive with other defensive sectors, like ETF yields and stuff like that. That's what's going on here after inflation consideration, because some may ask, well, if rates are going up, are defensive sectors as attractive? And the answer is it depends. Are real yields going up too, or is it just is it really just inflation expectations rising, right? Or are you getting like this net real yield gain? Because if real yields stay the same, what's happening is your inflation expectations are rising. And if inflation expectations are rising, right, without necessarily the rates themselves going up and the real yields, what happens here is your equity, when you buy something like utilities or you buy something like real estate, healthcare, etc., these are defensive sectors, you're getting that inflation protection as equity, right? Because when you buy a bond, there's no growth component. But when you buy stock or equity, the companies can increase prices. Bonds can't. There's no margin protection on bonds. There's no price control on bonds. You're just eating the loss depending on your principal, your shifts in principal. So what happens here when you have rates moving up without necessarily the risk-free rate? If you back out everything from rates and you try and figure out what the risk-free rate is, you take out inflation expectations, you take out term premium, you just get like the bottom line risk-free rate. If that's not really moving, then the move in rates necessarily isn't as tragic, because what's basically happening is rates are going up right now because you're seeing this rise in bond volatility. And this bond volatility that you're seeing on the long end that's being picked up is driving these the long duration bonds, to trade more like equities. And now when you have long end trading like equities, like just the way it is, these rapid ranges, right? Term premium has to rise, because if I buy a 30-year duration bond, right, I'm basically writing a commitment to the government that I'm going to hold this bond for 30 years. So I have to sit on that bond for 30 years. Now, I'm also going to say, well, if bonds are trading like this, if TLT is moving, we just do a quick measurement from low to high here on a 12% range, right? Over what? 4 months? So I'm going to have this heightened volatility risk in my underlying. It might not even be inflation driven. It's just news related, whatever it is, right? So you have this wider range of volatility. Well, that I have an increased liquidity risk now, because if I need to sell my bond at any point, right, within 3 months I can be down 10%. So what happens is term premium, which is the price the investor is baking into the bond, so they're willing, it's the price that's being baked into the bond that entices them to buy it, right? It's a risk basically priced in. Term premium will go up in environments like this. And when term premium is going up and it's not really risk-free driven, it's bond yields are going up because they're becoming essentially more risky, it's not necessarily as bearish for XLU or some of these other ETFs, where as if like the Fed was on a hiking spree, because now they're just lifting that risk-free rate, and that makes everything less attractive. So what you were saying earlier, Artie, is absolutely right. It's not necessarily where rates are going, but what's driving them across the cycle and how they're getting there, and also the speed at which they're getting there. Like, another way to put this is, if we go back to the 30-year, if the 30-year went up 2 basis points and then down 1 basis point, up 2 basis points, down 1 basis points, a steady climb like that, it would be less impactful to the markets than if it went up, 25 basis points in 2 days, right? That, even though, let's just say 2 weeks from now, you're 20 basis points higher, but my method, you go up up very slowly, right? Less impactful than going there in just 2 sessions and staying there, because that's just panic. And there's fear that if it's liquidity risk in bonds, people taking money out of the market, people scared that something's going to break, and it just cascades until you have some sort of issue. So I think that the biggest issue at hand right now, like you were saying, is not so much where rates are, but where they're going.
Yeah. Well, from there, let's take a look at stocks. So, one of the questions that we have is where do we think it's going from here? Was this just a giant bear market rally and we were going to reverse back down to the lows, or is this it? Is this where we continue going and we get the next bull market?
Well, I would say this. If I had to guess what's going to happen here, because that's what anyone's going to be doing in a situation, right? I think that the regime is the most important where we are right now. We're currently in a slowdown regime, and we're in a slowdown deflation regime. What that is we don't have enough negative growth impulses to keep us in a strong risk off environment, which is what we would be in the bottom two portion quartiles here. And we are in these top two, which is slowdown. And if we could break above here, we go back to risk on. This is where the magic happens in risk assets. Slowdown risk assets can do okay, but we're not really out of the woods yet. We've been doing great progress since like March, right? March 21st. We were down in the trenches and we've done a lot of repairing in the last 2 months. Nonetheless, we're not out of the weeds here just yet. So if I had to guess looking at the NASDAQ, I'd say that the chop risk is just high, a little too high, obviously, for us to be positioned leveraged NASDAQ at the moment, leverage risk on. We're not in risk on, right? So it's a little shaky for us there. And I wouldn't be surprised if at some point we do see Momo, at least,
Yeah,
given the
I'm
type of
thinking the
move.
same thing. Like that was a huge move and that was moving with growth expectations. Like if you go back to the dashboard, we came off the bottom there, bottomed in April and moved up from there. That was with the whole NASDAQ rally coming up with growth. There was actual substance behind it. Now, over the last 2 weeks or so, growth has stalled. And yeah, we hit 0% growth and started coming back. And it does coincide with the Nasdaq. Like the Nasdaq hasn't really gone anywhere in the last week and a half, so it does kind of coincide with the growth in our system. And yeah, if this growth can't continue, then for sure I could see a pullback to Momo. Probably not to the lows unless we see more issues coming with the China negotiations, because that's really what stemmed this whole rally in the first place. So if that gets cut back and we're back in the same situation where there's tension with China and the trade, then we can see lows. But if that doesn't happen, there's still trade deals, there's still negotiations happening, but growth is just coming back. I could definitely see some chop and some a Momo touch before heading higher once things settle down a bit. That's the way I see it.
Yeah, I think you're right there. I mean, look, we growth peaked here on May 5th, 14th, right? And basically has been fading since. So we go to NASDAQ May 14th. I mean, like what is that right here? It just coincidentally, like market hasn't been able to really ramp up higher. I mean, given what a stellar move off the lows, but we're at this point now where I think some people don't look at it like this, but this is how I look at the market. Like obviously we need, if we break everything down to a line chart and we just take everything off, and this is like very bare bones technical, right? You're basically on a one time frame. You take your line and just go up off the lows. You're any support, any bounce. This one, right? You can go down here. This is pretty much what you're doing. You're one time framing off the lows. You put the lows in, and you haven't had any serious pullback since 420, 430, 440 on the Qs. It's just been up only. Now, you can obviously argue, well, look, like a lot of this garbage here was just trade related and that got unwound. Yeah, absolutely. But when price moves like this, down and up, like you end up running the risk of just catching range bound price action for some time until you can really consolidate and shake out that risk. And I don't think we've shaken out that risk yet. So I'd say like if you're an equity bull, long stock, the first thing that is working in your favor right now is you are bullish trend here on the Nasdaq. So that's obviously supportive. But I would love to see some dips, and I would love to see those dips hold because that would add confidence that you're now breaching, you basically have a one time look, you have a pop and a trend flip here. Give me a dip, show me the dip hold. Like every bullish trend, you get some sort of dip. Here you have this pop, and this is a very light bearish trend. Obviously, nothing like we've been seeing here. You get this pop, this consolidation, and it continues higher. I think we need to find a little bit more of a bearish trend, like anywhere back here. A good example. Here you come up, there's no dip, just holds and it grinds up. This is again post COVID, so I think obviously it's a little bit different, but I would personally like to see a dip hold. Sometimes, as you just saw, they do go, but I'd like to see a dip hold at least if you don't have the system on your back.
Yeah, I think really the main thing to look at is the growth index on the system and just see if that's able to go bullish trend and get us into risk on. If we're in risk on, like even if we're up here at 513, 514, I would be very confident that it's going to go higher if we have growth backing it.
I think that's a good point. Like these transitions here, pretty much coming with risk on, right? Like outside of COVID, when you came out of COVID, you pretty much flipped risk on pretty quickly. And that kind of takes a lot of risk off the table in terms of your fear of downside. I guess my intuition for a dip here is not necessarily a requirement for trends that flip. Like it's not like you flip bullish trend, you have to dip. But given we're not in risk on right now, I think to me, it would be more comfortable to see price dip, hold, and or we just get a regime flip. If we get a regime flip, I'm with you on that. Like we're gonna just send it, in my opinion. But if you don't, you have a lot of look at this. You have what 2 months here, almost 3 months of sideways action up here. And if you just break this down into let's just do a little sketch here on the chart, right? You go sideways, like we're back into that range right now. So from the lows, I'd like to see some sort of consolidation here and go as long as we're in this like slow down, non-risk on regime. If we go risk on, that'll I think will be what punches us through. And I put this up on X earlier, it was today or yesterday, that like if you look at liquidity conditions, right? We're essentially in a position here where we've kind of hit the upper ranges on liquidity conditions. So makes sense given the type of rally we've had. And this goes back to my point of saying I'd like to see a dip because liquidity conditions are essentially maxed out. And the only thing left here, I think, to carry us forward would be like what you said already is getting that regime pivot. You get that risk on regime pivot. I think you get that growth impulse flipping back to positive territory, and that will ignite a bid in the markets. But if not, this this flip here seems kind of stretched, and I think a pullback is just appropriate to kind of give it some time to consolidate.
Yeah. I wonder if Bitcoin is the canary in the coal mine, though. Like, we are seeing Bitcoin moving quite a bit now. And Bitcoin started moving uh, before the
Way,
NASDAQ.
yeah, way earlier. Yeah.
So I wonder if it's kind of telling us, hey, maybe growth is actually going to be coming back pretty soon here. And it's just ahead of our system and ahead of uh, equities at the moment.
Yeah. Look, I mean, Bitcoin is great. We're long Bitcoin right now, so we're taking advantage of this aggressive move to all time highs. But at the same time, in a way, it's also been one time framing. Bitcoin has not been able to go under mid vamp at all, and that's not bearish. I don't want anyone to say like, oh, that means it's going down. It just means that every dip that you have is a test, right? If the dip holds, it adds confidence to the move, right? It prevents you from having these stretched upward moves and these violent downward moves. Like a good example would be like here, right? We one time frame all the way up, and then this dip holds, right? And it goes up again, and the dip holds, and it prevents us from like walking back the gains. But that's essentially like a pause, consolidate, and a strength builder. So we've hit all-time highs. I'd be watching mid-vamp if you're long Bitcoin. And as long as that holds, we should go up. But just because you lose mid-vamp doesn't mean the move's over. Just get ready for some consolidation. And that would be honestly a very bullish sign to me if we can get that. Nonetheless, I don't want it, we're long it, but if I do see it, if we do get it, it's bullish till we're out of risk off, and until we're in risk off, right? We're below the slowdown barrier, or we're bearish trend on Bitcoin. So as long as those two things don't print, like, we're going to stay long Bitcoin. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com.